Welcome to the Deep Dive, your daily source for clarity in a world just overflowing with information. I'm Nick, one of your digital guides, and it is Monday, August 25th, 2025.
Day 43 since the start of World War III.
Indeed. Here, we try to cut through all that noise, extracting the most crucial insights from, well, a whole stack of sources, articles, research, our own notes, to offer you a direct path to being truly well-informed.
And hopefully with some surprising facts and maybe just enough engagement to keep you hooked.
That's the goal.
And I'm Pi, here to help connect those dots, synthesize the complex currents shaping our world, and ensure you grasp not just the what, but more importantly, the why behind today's most significant events.
Right. Our mission is really to transform dense data into engaging, actionable knowledge tailored specifically for you.
Exactly.
Absolutely. So today we're embarking on a pretty comprehensive journey. I'll be guiding us through the intricate geoeconomic landscape. We'll unravel the American economic outlook, some major market signals, and the, frankly, surprising realities of the housing market.
Yeah.
Then we'll pivot to the deepening economic crises in giants like China and other critical spots, Saudi Arabia, Germany. Quite a lot to cover there.
And then I'll take the lead on the political and military fronts. We'll examine Europe's shifting influence, the escalating proxy conflict in Myanmar, and then, with a really particular focus, the brewing storm around China and Taiwan.
That's a big one.
It really is. And we'll wrap up with a concise look at the latest U.S. domestic news, including some key developments in cybersecurity and tech. So yeah, it's a packed deep dive. Let's jump right in.
Okay, part one, geoeconomic briefing. Let's start by unpacking the American economic outlook. It truly feels like a delicate balancing act right now. Our sources are consistently pointing towards a potentially significant shift from the Federal Reserve.
Right.
There's a very high probability, and this is according to market expectations tracked by the CME FedWatch tool, which is, a key indicator for future rate changes, that the Fed is poised for a September rate cut.
And the number's pretty staggering, isn't it?
It is. We're seeing an astounding 89.2% chance priced in, especially after Federal Reserve Chair Jerome Powell's recent speech at Jackson Hole. For many, it feels like it's almost a foregone conclusion.
Yeah, 89.2%. That's not leaving much room for doubt in the market's mind.
Not at all. Now, the Fed, as you know, operates under this dual mandate, fostering maximum employment while also maintaining price stability. It's a perpetual tightrope walk.
And what's fascinating, and I think a really critical challenge for Powell right now, is the conflicting economic data they're wrestling with. It pulls them in both directions.
Exactly.
On one side, we've observed these weakening labor market signals. The July jobs report, for instance, it was described in some analysis as shockingly bad. Only 73,000 jobs added.
Which is low.
Very low. But the real kicker, the real concern, was that massive 258,000 downward revision for May and June. That paints a picture that job creation is, deteriorating.
Right. That revision really changed the narrative. It wasn't just one bad month.
Precisely. And that data certainly provides a strong argument for a rate cut, to support employment.
Yet on the other side of that tightrope, we have these persistent inflationary pressures. Core CPI, that's the Consumer Price Index, excluding volatile food and energy, it stands at 3.1%.
Still well above target.
Well above the 2% target, and it actually ticked up from 2.9% the prior month. So no relief there. And here's where it gets even more complicated. The Producer Price Index, the PPI, which tracks prices at the wholesale level.
Right, what businesses are paying.
Exactly. That surged by 0.9% in July. That is the largest monthly increase since March 2022.
Wow, 0.9%. That's significant.
It strongly suggests that businesses will soon, or are already, passing these higher costs on to consumers. So, inflation's not exactly receding quietly into the night.
So this raises the crucial question. How does Powell reconcile these competing pressures? You've got slowing jobs, but sticky inflation.
Right. And Powell's perspective, as conveyed in our sources, seems quite nuanced. While he acknowledges the rising downside risks to employment, he has to, given the data he holds this belief, or at least is projecting this belief, that tariff-driven inflation will be a short-lived, one-time shift in the price level.
Okay, so he's kind of isolating the tariff impact, saying it's a bump, not a trend.
That seems to be the argument, not a continuous driver of inflation. He's effectively saying some of these price hikes are a one-off adjustment, not a spiraling problem. He also emphasized the unemployment rate, which was 4.2% in July, as a key metric.
Still historically low, even if job creation is slowing.
Exactly, especially given current immigration policies. The implication seems to be that if unemployment remains relatively low, Even with slower job creation, the labor market might still be viewed as being in a reasonable balance.
Interesting framing. So, what does this intricate dance, this balancing act, mean for you, the listener, the investor?
Well, an easier monetary policy is widely anticipated, that seems clear. And this could potentially lead to asset inflation across various markets, being stocks, gold, silver, even Bitcoin.
The classic more money chasing assets scenario.
It's a classic scenario where if more money enters the system via lower rates, it often chases a finite number of assets, pushing prices higher. So this suggests a period where economic data, every jobs report, every inflation print, will heavily influence market mood swings. That creates both opportunities for asset appreciation, but also potentially significant volatility.
Got it. Okay.
Now, let's turn our attention to the market signals themselves, which are presenting a fascinating, if maybe somewhat concerning, picture of concentration and underlying risks.
Yeah, I saw some reports on this. The concentration levels are pretty extreme, right?
Extremely. Reports consistently highlight what's being called the lowest market breadth and largest market concentration ever recorded.
Ever. Wow.
Ever. So imagine an investment party where almost everyone's crowded into just a few rooms, particularly those rooms playing the AI growth story theme. This means more investors are crammed into a smaller number of stocks than at any other point in history. It's a lot of eggs in very, very few baskets.
And that level of concentration, naturally, it brings significant risks. What are the sources saying about that?
Well, they specifically warn of what they call the AI bubble. If this bubble were to burst, and bubbles do tend to burst, eventually the potential for markets to come crumbling down is flagged as a serious concern.
Right. It highlights that fragility when gains are driven by just a narrow group of stocks, makes the whole market vulnerable if that group falters.
Exactly. It makes the broader market highly susceptible to a sharp correction if that enthusiasm deflates, even slightly.
But it seems not all the big players are chasing those same AI stocks. What about the bond market? I saw something about huge inflows there.
You did. We're seeing a massive, actually record-breaking $97 billion inflow into global bonds over just the last 4 weeks.
$97 billion in 4 weeks.
Yeah. This indicates that big institutional players, the so-called smart money, are positioning themselves for those anticipated Fed rate cuts we just talked about. They understand a key historical pattern.
Which is?
When the Fed resumes cutting rates, it often signals an economy that's headed into a recession, or at least slowing significantly. And that typically benefits the bond market as investors seek safer havens and expect future interest rates to fall further.
So it's a classic defensive maneuver, hedging their bets against a potential downturn, even as stocks might be rallying in the short term.
Precisely. They're looking past the immediate reaction and positioning for the next phase.
Okay, so let's drill down into specific sectors, because it sounds like there's a complex, maybe even divergent story playing out beneath the surface.
There really is. The S&P 500, which, tracks the 500 largest U.S. companies, is actually flashing very bullish signals, according to some technical analysis.
Okay, how so?
Well, about 72% of the S&P 500 stocks are trading above their 50-day moving average, which is a positive sign of breadth within the index. Plus, you have a positive relative strength index, or RSI, that's a measure of price momentum, sitting around 63, suggesting underlying strength. And machine positioning, automated trading systems, are reportedly moving into max long mode.
So, broad confidence in the big guys.
Seems that way for the S&P. However, if we shift our gaze to the NASDAQ, which is heavily weighted towards technology stocks, the picture changes quite dramatically, as presenting major warning signs.
Oh, what kind of warning signs?
We're seeing a much smaller percentage of tech stocks participating in this rally. Only about 58% are trading above their 50-day moving average. And crucially, the price hasn't pushed higher along with the market breadth signals.
So the index might be going up, but fewer stocks are actually driving it.
Exactly. This divergence suggests a potential rotation of big investors out of tech stocks, handing the ball over to a lot of retail investors. In essence, institutional money might be getting cautious about tech's high valuations, while retail keeps piling in. Machine positioning is also backed off a little bit on tech.
Interesting. A potential changing of the guard there, maybe not a healthy one long term.
Could be. Now, in contrast, the Russell 2000, which represents small-cap companies, actually offers one of perhaps the most bullish cases, according to these analyses.
Really? Small caps? Why is that?
Well, it shows strong internal momentum. About 74% of its stocks are above the 50-day average. But what's particularly intriguing is that asset managers and hedge funds are currently short the Russell. They bet against it.
Ah, the short squeeze potential.
Exactly. If prices continue to rise, these short sellers will be forced to buy back shares to cover their positions, potentially creating a bullish catalyst, a short squeeze that could theoretically send the Russell surging, maybe even to new all-time highs.
So a contrarian indicator coupled with strong momentum. The RSI is high at 67, positive Manny cross.
Yeah.
Yeah, triggered a buy open signal. That's a potent mix.
Is a potentially explosive setup there. Now, as we consider other key areas, commodities, tracked by DBA for instance, and energy, like the XLE ETF, are both displaying a bullish outlook.
Okay, what are we seeing there?
Well, the broad commodity basket, DBA, is breaking out to new highs not seen in maybe a year or two. This reflects either increasing demand or supply constraints, possibly both.
Right, tangible assets gaining traction. And energy.
The energy sector, XLE, which tracks big energy companies, has flagged a buy-open signal. Buyers seem to be quietly stepping in as it moved above key long-term averages like its 6-month volume profile and the 200-day moving average.
And that could also lead to a squeeze.
Potentially, yes.
Sure.
Similar to the Russell, if shorts get caught, it could lead to a vertical move, perhaps into the $93, $94 range for XLE. It suggests a possible shift in investor focus, maybe away from purely growth stocks towards these more value or inflation-sensitive sectors.
Okay, makes sense. What about the financial sector? Banks usually react to rate expectations.
Right. And XLF, which represents major banks, is surprisingly reaching new all-time highs, signaling a bullish trend.
Surprising given the rate cut expectation. Or maybe anticipating it?
Well, here's the caution raised in our sources. Rate cuts are not inherently bullish for banks if they don't translate into new lending, and especially if delinquencies rise as the economy slows down, which often happens when the Fed cuts rates because the economy is weakening.
Ah, right. Rate cuts are good for borrowing costs, but bad if nobody wants to borrow or can't pay back existing loans.
Exactly. So this suggests a potentially limited, maybe a 3-month window for this market rally in financials before the impacts of a slowing economy or recession truly begin to bite. It looks like a short-term opportunity with some significant longer-term caveats attached.
Got it. A tactical trade, perhaps, not necessarily a long-term buy-and-hold signal for banks.
That seems to be the read. Now, looking at gold, it's holding its ground pretty well, maintaining its 6-month volume profile support. But it faces notable resistance. Our sources describe 4 tops on the chart, indicating significant price barriers overhead.
So, a ceiling it needs to break through. Any targets?
A near-term trade target for gold is suggested around $317 for GLD, the ETF. Meanwhile, gold miners, like the GDX ETF, which are often seen as a leveraged play on gold prices, have shown strong performance recently, reportedly up about 3.46% on a recent MetaStrategy trade signal.
Okay. And bonds. We mentioned the big inflows earlier. What are the charts saying for something like TLT, the long-term Treasury ETF?
Well, for bonds, TLT, while machine positioning isn't fully committed yet, it's well off that 100% mark, the momentum is coming off a buy minimum.
So potentially turning up from a low point.
Right. If the price holds its key long-term support levels, like that 6-month volume profile, and if the MACD indicator attempts to bottom out and the RSI turns higher, well, that could be a very bullish indicator. The target suggested is around $90 for TLT.
Which aligns with those institutional inflows we talked about. Growing conviction in bonds as a potential safe haven or benefiting from falling rates.
It lines up nicely, yes.
Yeah.
Finally, let's consider the U.S. dollar. There's a common belief out there that the dollar is dead on Fed rate cuts, that it should weaken.
Right. Lower rates generally make a currency less attractive.
Generally. But our sources present a contrarian view here. A recession, or even just a significant slowdown, could actually create strong demand for the dollar.
Ah, the flight to safety aspect. The dollar is the ultimate haven asset.
Exactly. In times of global uncertainty, capital tends to flow into the dollar. And technically, it recently held its 50-day moving average after a pretty big drop. This suggests a potential rally, maybe all the way up to its 200-day moving average.
And if the dollar strengthens significantly?
That would likely cause a significant unwind for emerging markets. Capital would flow out of those generally riskier economies and back into dollar-denominated assets. It would create a pretty significant ripple effect across global financial systems.
So a stronger dollar is definitely something to watch, even with potential Fed cuts on the horizon. It's not a simple relationship.
Not at all. Okay, moving from the broader markets, let's narrow our focus to the American housing market. This currently presents a fascinating and sometimes quite stark tale of two realities.
Yeah, the affordability crisis is still a major theme, right?
Absolutely. At its core, we're seeing what's being called the mortgage divide. The cost of buying a home has, as you know, increased sharply in recent years, driven largely by mortgage rates essentially doubling from their lows.
And the numbers really illustrate that divide.
They do. To put it in perspective, take a $400,000 loan. If the rate jumps from, say, 3% to 7%, which isn't far off what happened, the monthly payment skyrockets from around $1,686 to $2,661.
Ouch. That's nearly $1,000 more per month.
Exactly. And this creates a very tangible wealth divide between homeowners who may be shrewdly locked in those super low rates back in 2020, 2021, and those brave souls trying to enter the market today, facing significantly higher monthly costs for the same house.
And this divide has had a profound behavioral impact, leading to what analysts are calling the lock-in effect.
Right. Americans are simply staying in their homes much longer than ever before.
And why wouldn't they?
It makes virtually no financial sense to trade a comfortable, low-rate mortgage for a much, much more expensive one, even if you want to move. So this behavior is actively reshaping migration patterns across the country.
How so? Where are we seeing the effects?
We see colder regions, particularly places like the Northeast, grappling with unusually tight inventories because people aren't moving out. Meanwhile, sunnier spots like Florida and Texas, which saw huge influxes earlier, are now experiencing increasing inventory and, in some cases, even year-over-year price declines.
So a regional divergence driven directly by interest rate economics, people are literally locked in by their mortgage rate.
Pretty much. Now, here's an intriguing paradox. The consumer spending paradox.
Ah, yes, the seemingly invincible American consumer.
Right. Despite what our sources describe as bad consumer sentiment surveys for roughly 2 years now, record high household debt, and rising delinquencies, especially in subprime auto loans, which are hitting a 15-year high, and unsecured credit card debt. Despite all that, the American consumer appears to keep on spending.
It does seem counterintuitive. How is that possible?
Well, it's partly explained by that housing divide we just discussed. Many homeowners are enjoying very low mortgage payments, which frees up cash flow compared to renters or recent buyers. Combine that with a relatively low unemployment rate overall and high asset prices benefiting savers and investors.
So it's not all consumers, but enough have cushions to keep spending.
That seems to be part of the explanation. There's also the impact, potentially, of consumers rushing to buy durable goods before new tariffs hit prices, pulling some spending forward.
Okay, that makes some sense. But this persistent spending, it doesn't really address the underlying structural issue in the housing market, which is supply, right?
Correct. There's a significant supply shortfall. U.S. homebuilders added about 1.4 million new homes in 2023, which was actually the highest number since 2007.
So building kicked up.
It did, but critically, it was not enough to serve the 1.8 million new households that were formed in the same year. There's still a gap.
And builders are facing headwinds trying to close that gap.
Big time. They face a multitude of challenges. Rising material costs, persistent labor shortages, restrictive zoning regulations in many areas, and on top of that, new tariffs are expected to push construction material prices even higher.
And the labor issue.
That's compounded by anti-immigration policies, which sources say will reduce the number of skilled construction workers. Homebuilders, our sources highlight, are particularly nervous about this tariff volatility, making them hesitant to break ground on new projects, even with strong demand.
So a tough environment for builders, which keeps supply tight.
Exactly. And it goes deeper than just current supply dynamics. There's a significant generational wealth divide at play in housing.
How is that manifesting?
Well, one stat is that 1 out of every 3 homes in the United States is now owned by people over 65. That group's share of homeownership has surged since 2012.
The baby boomers aging in place, holding on to housing stock.
Right. But what's perhaps even more striking is that the sharper fault line is within generations themselves.
Meaning?
The wealthiest 10% of millennials are now reportedly 20% richer than the wealthiest 10% of boomers were at the same age.
Wow. How?
It's not just about income from work. It's largely attributed to inherited wealth. Get this. 36% of young American homeowners receive financial help from family for their first home purchase.
So nearly 4 in 10 got a boost from family wealth. That's a powerful accelerant of inequality, fundamentally reshaping who can even access homeownership.
Absolutely. It creates a huge advantage.
Duh.
This brings us to a more sophisticated view of the mortgage as a financial instrument.
Okay, thinking beyond just a loan to buy a house.
Right. Homeowners are increasingly encouraged, or perhaps should be thinking, of their mortgage as an important part of their investment portfolio. Fixed-rate mortgages, for example, behave a bit like bonds. Their relative value shifts with interest rates.
While floating rate mortgages are more like corporate loans, adjusting in real time.
Exactly. And this perspective influences a household's broader financial portfolio, showing how deeply intertwined housing finance is with overall wealth management and financial strategy, especially in this volatile rate environment.
So what's the outlook then for this bifurcated housing market? Where are things headed?
Well, the consensus seems to be that mortgage rates are expected to stay in that range, maybe near 6.75% through the end of the year. The market itself is visibly shifting. There are now roughly 500,000 more sellers than buyers out there.
So inventory is rising, buyer demand is cooling.
Right. Pending sales are down. Yet, paradoxically perhaps, asking prices are still rising, albeit at a slower pace, about 2.2% year over year.
Hmm. Still rising despite more sellers than buyers. That suggests sellers are holding firm on price, maybe due to that lock-in effect. They don't have to sell cheap.
That could be a big part of it. It's definitely a market in flux, caught between policy expectations, like potential Fed cuts, and the harsh financial reality of current rates. Affordability remains a huge hurdle for many potential buyers.
Okay, a complex picture indeed.
Now, let's pivot to the global economic trouble spots. Because while the U.S. juggles its own complexities, the world stage is presenting some truly dramatic narratives. And first up, it's impossible to ignore China's deepening economic crisis.
Yeah, the headlines coming out of China have been pretty alarming recently.
They really have. It's a situation one source vividly described as the country having potentially forgotten how to grow. That's a strong statement. The situation seems to have taken an abrupt downturn, shifting from, quote, not working to holy crap starting around June and really heading into July 2025.
Holy crap levels.
Yeah.
What are the indicators showing?
It's not just a slight wobble. The indicators are stark and reflect a fundamental structural slowdown. Bank lending, for example, contracted at the worst rate in over 20 years. Household loans actually fell by $500 billion.
Fell. Not just slowed growth, but contracted.
Contracted. Industrial production slowed.
Yeah.
Consumer spending contracted for 2 months running. That's the worst slump since the zero-COVID lockdowns in late 2022. And fixed asset investment, particularly from the private sector, absolutely plunged. One estimate put private FAI falling at something like a -7% year-over-year rate in July.
Wow, those are not minor adjustments. That points to a fundamental slowdown across the entire economy. Deflationary signals must be everywhere.
They are. It's a classic case of overcapacity meeting under demand. We're seeing deflationary signals all over China's economy, even in the energy space. While electric vehicles get a lot of media attention for potentially lowering oil demand.
Right, the EV narrative.
Yeah, the real dent, according to these sources, comes from the other part of industry grappling with overcapacity, meaning there's just too much production capacity factories, equipment for the current level of demand, both domestically and globally. That leads to falling prices and economic stagnation. This profound economic slowdown is far more impactful on energy demand than shifts in consumer vehicle choices right now.
And Beijing's attempts to counter this, the usual stimulus measures.
They've stunningly failed, according to the analysis. The big bazooka policies they rolled out starting in September 2024, including massive government bond issuance, something like 8.9 trillion yuan in the first 7 months of 2025, compared to 4 trillion in all of 2024.
So huge fiscal push.
Huge. But it has simply not stimulated the economy as hoped. Lower policy rates and this fiscal expansion are now being seen merely as a response to the weakness, not a solution for it. It indicates the depth of the structural issues at play. China seems to be grappling with a fundamental structural crisis, not just a cyclical downturn.
Which leaves Beijing's traditional stimulus tools looking pretty ineffective, and confidence must be shattered.
It appears so. And this weakness extends right into the banking sector, which is showing increasing distress. The total outstanding loan growth rate fell below 7% year over year in July. That's below 7% for the first time ever recorded.
First time ever, and the rate of slowdown.
It's continuing to slow at a staggering second-order rate, meaning the slowdown isn't just continuing, it's accelerating dramatically. This suggests Chinese banks are becoming much more cautious, increasingly only lending to their best and safest borrowers.
Which, of course, starves the broader economy of credit and just exacerbates the slowdown, a negative feedback loop.
Exactly. And then, sort of symbolically, but also with real impact, we have the final chapter of Evergrande.
Ah, the poster child of the property crisis. What happened?
The once towering developer was officially struck from the Hong Kong Stock Exchange, delisted. marking, as one source put it, the end of Evergrande's turbulent saga.
Wow. End of an era.
Truly. It rose to a $50 billion valuation back in 2017, but became the most indebted developer on Earth, with a debt load topping $300 billion by 2021. Its default, as you'll remember, shocked confidence in China's financial system and really shattered the long-held belief that firms like that were simply too big to fail.
And the fallout for homeowners and creditors.
Liquidators are now overseeing something like 1,300 incomplete developments. But the recovery for creditors has been abysmal. Only about $255 million have been recovered so far from $45 billion claimed by overseas creditors.
Pennies on the dollar.
Barely. Its delisting really feels like the gravestone for an era when China's growth was built quite literally on debt and concrete.
A stark symbol. Yet despite all this economic gloom, isn't the Chinese stock market doing surprisingly well?
It is, and that's the peculiar stock market anomaly. Chinese stocks are in fact soaring. But our sources view this largely as an artificial trend, eerily reminiscent of the setup before the 2015 crash.
Artificial? How so? State buying.
Potentially state support plays a role, but a simpler explanation offered is that money in China has nowhere else to go. With the property market in crisis, and maybe capital controls limiting outflows, equities become the least worst option for savings.
So a bubble inflated by a lack of alternatives, not genuine economic optimism, detached from reality.
That seems to be the consensus view, a market driven by necessity rather than fundamentals. Okay, next on our list of global trouble spots, Saudi Arabia. Here we see an incredibly ambitious vision meeting a stark fiscal reality.
Right, Vision 2030 and all the mega projects, but they have immense oil wealth, don't they?
They do. Despite possessing the world's second-largest oil reserves, a mind-boggling 266 billion barrels, and being the world's largest exporter, Saudi Arabia is reportedly facing a cash crisis.
A cash crisis? With all that oil, how?
The core issue, quite simply, is overspending. Specifically, overspending on those hugely ambitious projects designed to diversify its economy away from oil dependence.
Right, the cornerstone being Vision 2030 and its flagship NEOM project. That includes the line, right?
That's the one. The line, a visionary, maybe even fantastical, 100-mile-long linear city, supposedly 3 stories high, encased by mirrored walls, entirely powered by renewable energy, and designed for 9 million residents with 20-minute end-to-end travel.
It sounds like science fiction. Extremely ambitious.
Extremely expensive.
Yeah.
Therein lies the problem. These futuristic endeavors cost astronomical sums. Our sources indicate that foreign direct investment, which is really crucial for funding these plans, has been significantly lower than they originally expected.
Ah, so the foreign money didn't show up in the volumes they needed.
Exactly. This has forced the Saudi government to fund a bigger proportion themselves, leading to a dramatic drop in their cash balances held at the central bank. They're dipping into their reserves at what seems like an unsustainable rate to keep these projects afloat.
And this financial strain is compounded by oil prices, I assume. They need a high price to balance their budget with this level of spending.
Precisely. There's an ongoing oil price challenge. The IMF estimated that Saudi Arabia needs oil prices to be at $96.02 per barrel to break even fiscally for 2024. It dropped slightly to $84.07 for 2025, but still quite high.
And where has Brent crude been trading?
Well, it really only consistently traded at that $96 level during the period immediately following Russia's invasion of Ukraine back in 2022. OPEC plus production cuts, despite their best efforts, just haven't been able to control the price and keep it that high over the long term. There's a significant gap between their fiscal needs and market realities.
So what are the consequences of this cash crunch and lower than needed oil prices?
Well, the consequences are already becoming visible. While Saudi Arabia's overall balance of trade remains positive, they still export more than they import. Its current account, which includes services and transfers, shows a significant downward trend since late 2022. That reflects the massive spending draining from its reserves.
And the impact on Vision 2030?
It's led to reported cutbacks on their Vision 2030 plan. This means iconic projects like NEOM and the Line are unlikely to open as originally estimated, or certainly not with the initially projected scale and timelines. Some parts might be delayed or scaled back significantly.
A stark reminder that even immense oil wealth has its limits when ambition outpaces revenue.
Indeed. Okay, our final geoeconomic trouble spot for today takes us to Germany, an economy grappling with what looks like a deep and persistent structural crisis.
Yeah, the German situation seems particularly worrying given its role as Europe's economic engine.
It's a sobering picture. Sources describe Germany's economy as being in continuous recession for the last 3 years. The economy is continuing to contract, living standards are falling, government debt is ballooning, and the trend of deindustrialization continues at an ever more rapid pace. The traditional engine of Europe seems to be sputtering badly, losing its competitive edge.
What's driving this? Is it just energy costs from the Ukraine war or something deeper?
Energy is part of it, but sources point to something deeper, including a perceived leadership disconnect. Chancellor Merz is seen by critics as being completely absorbed and committed to Project Ukraine and accused of not really interested in the underlying problems of Germany itself.
Focusing externally rather than internally.
That's the criticism. He's accused of leading his party, the CDU, into Merkelism on steroids by aligning closely with the left-of-center SPD party, which has resulted in policies leading to ballooning debt, a stark contrast to former Chancellor Merkel's much tighter fiscal controls. This perceived focus on foreign policy, at the expense of pressing domestic economic issues, appears to be a major point of contention.
And that must have political consequences.
Significant political fallout. The AfD, the Alternative for Germany party, has reportedly become, without a doubt, the most popular party in recent polling, and has now overtaken us, the CDU-CSU, as the main party on the right.
Wow, that's a historic shift in post-war German politics.
It really is. And it's largely attributed by these sources to Merz's perceived preoccupation with foreign policy and the internal struggles within his governing coalition, all while the economy tanks. The political landscape is being fundamentally reshaped.
And beyond the politics, is there a concrete plan to fix the economy?
That's another major criticism. Germany apparently does not have a true economic plan to restructure its economy, raise productivity, or even significantly digitalize. Our sources incredibly note that parts of the German public sector still rely on fax machines in 2025.
Fax machines, seriously?
Seriously.
Wow.
It underscores a deep-seated resistance to modernization, according to these analyses. This lack of a forward-looking strategy prevents the country from adapting to modern economic challenges and addressing its long-term decline.
Leaving it vulnerable in a rapidly changing global economy. And what's this about EU Eurobonds? That sounds controversial for Germany.
Highly controversial. Merz appears ready, according to these reports, to sign up to European Commission President Ursula von der Leyen's EU Eurobond strategy. This is a move involving mutualized EU debt that former Chancellor Merkel absolutely refused to do.
Because it essentially means Germany, with its stronger credit rating historically, would be on the hook for the debts of less fiscally disciplined EU nations.
Precisely. This decision is seen by some German commentators as potentially sinking Germany by essentially sharing its credit card with other EU nations. They fear it will lead to ballooning debt across Europe, with Germany underwriting a significant portion of it. It's a dramatic potential shift in fiscal policy with potentially far-reaching and possibly very negative consequences for Germany's financial future.
Okay, wow. So Germany's economic struggles, combined with these policy choices, it paints a stark picture. And Nick, that really raises the question, how do these financial tremors in Germany, and similar ones across the continent, translate into political and military shifts on the global stage? Let's turn now to part 2. Political and military conflict briefing, starting with Europe's diminished influence and internal strains.
Yeah, that seems like the logical next step. If the economic engine is sputtering, what does that mean for Europe's power?
Well, the assessment is quite blunt. Former ECB chief Mario Draghi, who is, a highly respected voice in Europe, has sharply stated that the EU can no longer believe its big economy brings it global power and influence.
That's a powerful statement from someone like Draghi.
It is. He acknowledges that its member states' economies are, in his words, a mess. They're deindustrialized. And frankly, he says, no one respects the European Union on the global stage anymore. He even used the term global laughingstock.
Wow, a global laughingstock.
Yes,
That's harsh. And does he attribute this decline to anything specific?
He and other analysts largely attribute this decline, at least in part, to the sheer cost of Project Ukraine, the hundreds of billions poured into supporting Ukraine.
Right, we mentioned Germany's focus on it.
Exactly. And this extensive support, while seen as politically necessary by many leaders, has led to the effective demilitarization of many EU member states, draining their own defense stockpiles and capabilities.
And the numbers are huge, right?
Monumental. Our sources highlight that the EU dispersed another 9 billion euros to Ukraine just in 2025 from frozen Russian assets alone. And they claim to have sent a staggering total of 180 billion euros over the last 3 years.
180 billion euros. That's a massive investment with very tangible consequences for Europe's own military readiness and its strategic autonomy.
Absolutely. And we're also seeing clear signs of Italian opposition to intervention, reflecting deep internal divisions within the EU itself. Italy's deputy prime minister, Matteo Salvini, quite mockingly suggested French President Macron should hop on a tram and pick up a rifle and go to Ukraine yourself.
Ouch. Not exactly diplomatic language between allies.
Not at all. Salvini added, with some sharp political humor perhaps, that not even a Frenchman would follow him. This direct challenge actually prompted French authorities to summon the Italian ambassador. It really highlights the deep internal divisions and diplomatic strains simmering within the EU over the war's continuation and cost.
And the instability isn't just about rhetoric, right? Didn't something happen in the Netherlands?
Yes, we're witnessing actual Netherlands government instability. The Dutch foreign minister resigned very recently after the cabinet failed to agree on imposing sanctions on Israel for its ongoing actions in Gaza and its reported annexation plans in the West Bank.
So a disagreement over foreign policy, separate from Ukraine, caused a major government figure to resign.
Exactly. This significant disagreement could potentially put the Dutch government in a bit of a problem, further eroding political cohesion in Europe at a really critical time.
And across the channel, in the UK, things aren't looking great there either, economically.
No, the UK's economic peril is also a major concern, adding to the European picture. Leading economists are now openly warning that Britain might be heading towards a 1970s-style debt crisis and potentially even a bailout from the International Monetary Fund.
An IMF bailout for the UK.
That's the warning. They're attributing it directly to the current government's, specifically Chancellor Rachel Reeves's tax and spend gamble. It paints a picture of broader economic fragility impacting some of the most influential nations in Europe, compounding the challenges the continent faces.
Okay, so a picture of economic strain leading to diminished influence and internal fractures in Europe. Let's move further afield now. What about Myanmar?
Right, let's turn to the Myanmar proxy conflict. It's a truly tragic situation described in our sources as a failed state in the Indian Ocean corridor, effectively collapsing in real time.
It's been years now since the coup, right?
4 years, almost 5, since the early 2021 coup. Myanmar is now widely recognized as a failed state. The human cost is staggering. Some 82,000 lives estimated lost, and 3.2 million people displaced internally or externally. The central military government, the junta, controls just a fifth of the country's territory.
Only a fifth. So who controls the rest?
That's the problem. It's created a dangerous power vacuum, turning vast swaths of the country into a hub for illicit activities, narcotics production, human trafficking, weapons smuggling. It's become a black hole on the map.
And this power vacuum has led to fragmented control, I assume. Warlords, ethnic groups.
Exactly. Much of the country has fallen outside any central government control. Instead, you have patchworks of separatist strongholds dominated by various ethnic armed organizations. You've got the Kachin Independence Army in the north, the Arakan Army in the west, various Chin militias, Karen and Karenni armed groups in the east, different Shan factions, all pursuing their own distinct goals, which aren't always aligned.
What about the opposition government, the NUG?
The People's Defense Force, or PDF, which was formed by the exiled civilian government, the NUG, does operate across central and southern Myanmar. But even they have strained relations with many of these long-standing ethnic militias. It's an incredibly complex, multi-sided conflict with no clear central authority on either side, really.
And this chaos, this vacuum, it must be attracting outside powers. How are foreign powers hedging their bets here?
That's what makes it a true regional proxy war. Let's start with China. China has deep investments and strategic stakes in Myanmar, so its approach is to play all sides.
How do they manage that?
Well, they supply military hardware like drones and armored vehicles to the central military government, the junta, but at the same time, they reportedly turn a blind eye to Chinese-made weapons flowing to rebel factions, often through border trade or intermediaries. There's even said to be an unspoken rule that most armed groups, regardless of allegiance, avoid targeting Chinese assets like the crucial oil and gas pipelines running through Myanmar to China's Yunnan province, or the various Chinese-backed economic zones.
Why is Myanmar so critical for China?
Geography. Myanmar is China's only immediate neighbor that offers direct overland access to the Indian Ocean. This allows China to bypass the congested and strategically vulnerable Strait of Malacca for exporting goods and, importantly, importing fossil fuels from the Middle East and Africa. It's a vital strategic corridor for Beijing.
Okay, so China plays all sides to protect its strategic interests. What about India?
India has attempted to copy China's balancing strategy, but our sources suggest has largely stumbled. India's primary focus is different, securing its volatile northeastern frontier from various separatist insurgent groups that have historically operated from bases inside Myanmar.
So India's focus is cross-border security.
Primarily, India has quietly cooperated with Myanmar's military leadership, the junta, sharing intelligence and even conducting cross-border counterinsurgency operations, reportedly in May and July of 2025. However, unlike China, India lacks strong ties with Myanmar's powerful ethnic militias and doesn't have the same level of economic leverage. This makes its balancing act much less effective.
In the U.S., what's Washington's role in this?
The United States has taken a different approach, at least publicly. They officially avoid arming groups fighting the central government, with stated support limited to non-lethal aid for the exiled civilian government, the NUG.
Non-lethal aid only. Is that believable?
Well, the analysis suggests it's most likely providing more covert assistance than it publicly admits. The U.S. is also urging neighboring Thailand to play a more active role, possibly as a conduit for aid. And significantly, the U.S. is building a massive new $248 million consulate complex in Chiang Mai, northern Thailand, right near the Myanmar border.
A consulate that big near the border. What's the thinking there?
It's widely believed this is intended to expand American intelligence capabilities in the region, allowing closer monitoring of Myanmar and potentially facilitating covert operations. Some local sources even claim the U.S. is contemplating establishing a supply base in Cox's Bazar, Bangladesh, to support insurgent groups, and maybe even pushing for a no-fly zone over Rakhine State to counter China's access to the Indian Ocean corridor there.
Wow, so potentially much deeper involvement than publicly stated, aimed at countering China.
That seems to be the underlying strategic goal. Finally, there's Russia. Russia's support for the junta appears to be fading.
They were a key arms supplier, weren't they?
Yes. Myanmar's military had consciously reduced its reliance on China by building defense ties with Russia, buying things like MiG-29 fighter jets and Mi-35 helicopter gunships, which have become increasingly crucial for the junta's survival, especially for airstrikes against rebel groups.
But Ukraine changed things.
It seems so. With Russia's attention and, more importantly, its military resources consumed by the devastating war in Ukraine, it's unclear how much of that support still continues today. Russia likely can't spare the equipment or the attention. This leaves a significant void in the central government's foreign backing, potentially tilting the already precarious power dynamics further away from the junta.
A complex, tragic situation with major regional players all maneuvering for influence. Okay, let's turn now to perhaps the most significant geopolitical flashpoint discussed today. The brewing storm. China and Taiwan.
Indeed. Whether China will actually invade Taiwan is truly one of the greatest geopolitical questions of the 21st century. There's no understating the stakes.
And Xi Jinping has made reunification a core goal, hasn't he?
Absolutely. Chinese President Xi Jinping has repeatedly called reunification the essence of the country's rejuvenation, setting a target date to achieve it by 2049, the centenary of the People's Republic. But U.S. military officials have warned China could be capable of invading, or might choose to invade, much sooner, maybe as early as 2027.
2027, that's not far off at all. The stakes, as you said, are monumental for global stability and the entire future of the Indo-Pacific region.
And the magnitude of the challenge for China, should it actually choose to invade, is immense. The Council on Foreign Relations describes a potential invasion as the most complex military operation in modern history.
Most complex in modern history. Why?
Well, partly because of Taiwan's 75 years of focused resilience and strategic resolve in preparing for exactly this scenario. Naval analyst Ian Easton put it bluntly, "Make no mistake, this is not a PRC bluff. The threat to Taiwan is real and grave." But the difficulty for China is equally real. It's an all-or-nothing scenario for Xi and his legacy, with potentially catastrophic global ramifications if it goes wrong.
So given these stark realities, Taiwan has obviously invested heavily in deterrence. What are its main defenses?
It starts with basic geography. Taiwan isn't connected to the mainland. It's separated from China by 130 to 220 kilometers of open water, the Taiwan Strait.
Not an easy crossing, especially under fire.
Not at all. And the region experiences 2 strong monsoon seasons each year, making a large-scale seaborne invasion only viable for a few months out of the year, typically spring and early autumn. Furthermore, any large-scale military buildup, the sheer number of ships and planes needed would almost certainly be detected by satellites and intelligence long before it occurs. This lack of strategic surprise could turn the Taiwan Strait into a deadly shooting range for Taiwanese defensive forces.
So geography is the first line of defense. What about actual defensive preparations?
They are extensive and multi-layered. Back in March 2025, Taiwan held its first ever large-scale anti-landing combat drills, specifically focused on repelling an amphibious assault. They deployed various obstacles along potential landing beaches, things like oil barrels rigged to explode, floating platforms, sea mines, and traditional anti-tank hedgehogs.
Making the beaches themselves hazardous?
Extremely. Plus, the island's shallow coastal waters and a general lack of suitable deepwater ports would force large Chinese amphibious ships to anchor far offshore. This would expose them for longer periods to precise Taiwanese missile and artillery strikes from systems like the indigenous Xiongfeng III anti-ship missile, U.S.-supplied harpoons, and the powerful Thunderbolt 2000-wheeled multiple launch rocket system, MLRS.
Okay, so make the crossing and the landing as difficult and costly as possible. What if they get ashore?
Should coastal defenses somehow be overwhelmed, Taiwan's strategy includes robust inland resistance. Forces are prepared to retreat into the island's rugged central mountain ranges to wage protracted guerrilla warfare.
Using the terrain to their advantage.
Exactly. They have prepared facilities like a reported network of tunnels that lead to fortified underground hangars near the Chiashan Air Force Base in Hualien, capable of sheltering up to 200 fighter jets with months of supplies, safe from initial bombardment. Soldiers are also trained to sabotage critical infrastructure bridges, narrow mountain passes, tunnels to slow any enemy advance, turning the island's challenging terrain into a formidable multi-front defensive barrier.
And crucially, what about the people? Is there the will to fight?
That appears to be a key deterrent, an unwavering will to resist. Recent surveys consistently show that over 75% of Taiwanese respondents would be prepared to fight if China invaded. This reflects a society that, after decades of living under this threat, takes its sovereignty seriously.
And the reserves.
Taiwan also boasts a vast reserve force of more than 1.5 million people who could potentially be mobilized. Compare that to China's estimated 510,000 reservists. This human element of defense, combined with a strong and distinct Taiwanese national identity, presents a formidable psychological and practical challenge to any potential invader.
Okay, so geography preparations will. What of the overall military strategy? China still has overwhelming numbers and firepower.
True. China has roughly 2 million active troops versus Taiwan's 169,000. They have vast superiority in helicopters, warships, fighter jets, tanks, submarines, and ballistic missiles. Recognizing this imbalance, Taiwan has adopted what's called the porcupine strategy.
The porcupine strategy, making itself hard to swallow.
Exactly. The idea isn't to match China plane for plane, ship for ship. That's impossible. Instead, it counters the enemy by deploying large numbers of relatively cost-effective defense measures designed to inflict maximum pain on an attacker. Think swarms of anti-aircraft Stinger missiles, mobile anti-ship harpoon missiles, sea mines, and increasingly sophisticated drones.
So asymmetric warfare.
Yeah.
Using cheaper, smaller weapons to take out expensive platforms.
Precisely. For the cost of just one advanced F-16 fighter jet, Taiwan could acquire maybe 6 mobile harpoon launch systems or as many as 135 shoulder-fired Stinger missiles. The goal is to make the cost of invasion prohibitively high for Beijing, making Taiwan a hard target to swallow.
And the war in Ukraine must have influenced this strategy.
Absolutely. The lessons from Ukraine were stark. Seeing Ukrainian soldiers successfully destroy huge amounts of advanced Russian military hardware tanks, helicopters, ships using relatively lightweight, portable weapons like javelins and stingers really solidified support for the porcupine strategy within Taiwan and among its international partners. Taipei recently announced plans to procure an additional 1,985 Stinger missiles, showing a clear commitment to this asymmetric approach. It prioritizes mobility, survivability, and the ability to inflict heavy losses on an invading force.
Is Taiwan also developing its own weapons? Relying solely on U.S. supplies seems risky.
It is risky, and they know it. Taiwan is heavily investing in indigenous defense capabilities, partly due to chronic delays in some promised U.S. weapon shipments. Taiwan's government passed a special military budget back in 2021, specifically to improve its domestic defense industrial base.
What have they produced?
They recently unveiled 5 new types of indigenous military drones, including reconnaissance models like the Albatross II and attack drones like the Cardinal III. They bolstered their arsenal with a new anti-drone defense system in February 2024. And perhaps most significantly, they're nearing completion of their first domestically built submarine, the Haikun or Narwhal.
Taiwan is building its own submarines.
Yes, the first of a planned class of 8. Submarines are seen as a key asymmetric advantage for threatening Chinese surface ships in the Strait. Taiwan is also mass-producing critical ammunition domestically, like advanced tungsten core armor-piercing rounds and essential artillery shells, 155 millimeters and 120 millimeter. This drive for self-reliance is a critical component of their long-term defense posture.
Okay, so Taiwan is doing a lot to defend itself. But the big question always remains, would the U.S. intervene? Let's navigate those murky waters of U.S. intervention and regional responses.
This is probably the biggest uncertainty. The official U.S. ambiguity on direct military involvement is a core part of the strategic calculus. The 1979 Taiwan Relations Act, which governs U.S.-Taiwan relations, stipulates that the President and Congress shall determine appropriate action in the event of an attack. But crucially, it states there is no legal obligation for direct U.S. military intervention.
So it's deliberately vague, strategic ambiguity.
Exactly. It keeps Beijing guessing and provides Washington with flexibility. Former President Trump, for example, has repeatedly stated he would never comment on that, choosing explicitly not to reveal my cards on whether he'd defend Taiwan. This ambiguity forces Beijing to factor in the possibility of U.S. intervention, which raises the risks significantly for them.
But despite the ambiguity, the U.S. is making preparations, right?
Yes, U.S. preparations are definitely underway. Washington has been actively stockpiling military equipment, ammunition, fuel, spare parts, and warehouses strategically located across the region, including potentially on Taiwan itself, to ensure faster supply capabilities if a conflict breaks out.
But could they actually resupply Taiwan during a war?
That's the challenge. Our sources caution that supplying Taiwan once an invasion has begun would be extremely challenging, especially if there's a blockade. China would likely prioritize cutting Taiwan off. This highlights the immense logistical hurdles of projecting and sustaining power across the Pacific under contested conditions, and it underscores why Taiwan's own stockpiles and self-sufficiency efforts are so critical.
Okay, so U.S. intervention is uncertain and resupply is difficult. What about other regional players? Is there a crescent of defense forming?
There are key allies, yes, but their responses would likely vary. Let's start with Japan. Japan is deeply concerned about China's military buildup and assertiveness. Concerns have led Japan to announce plans to nearly triple its defense budget over 5 years, reaching 43 trillion yen. They also scrambled their fighter jets against approaching Chinese aircraft 465 times in the last fiscal year alone.
So Japan is clearly worried. What could they do in a Taiwan conflict?
Japan could offer significant logistical support from its nearby bases, potentially strengthen security ties further, impose sanctions on China, and pursue diplomatic avenues. However, its post-World War II constitution famously renounces war as an instrument of state policy. While interpretations are evolving, direct military engagement remains constitutionally and politically complicated for Japan.
Okay, logistical support maybe, but direct fighting is unlikely. What about South Korea?
South Korea's sentiment is more mixed. One recent survey showed 64.5% of South Koreans support U.S. efforts to defend Taiwan. However, the newly elected president, Lee Jae-myung, is pursuing what he calls a more balanced approach between the U.S. and China. He commented quite pointedly, "Why get involved in whether China and Taiwan fight? That has nothing to do with us."
So a reluctance to be drawn in, prioritizing South Korea's own immediate security and economic interests with China.
That seems to be the calculation. It reflects a desire to avoid being dragged into a conflict that could severely impact the Korean peninsula.
Now, the Philippines seems to have taken a much stronger stance recently.
They have, quite dramatically. The country is actively preparing for potential involvement. Its military chief, General Romeo Bronner Jr., stated very clearly, "If something happens to Taiwan, inevitably we will be involved. We should have that mentality that we are already at war."
Already at war mentality. That's strong.
It is. And just last Friday, the Philippines and Australia announced a new defense agreement specifically designed to step up military cooperation and strengthen regional deterrence against China's activities, particularly in the South China Sea, but with clear implications for Taiwan. This pact paves the way for more frequent joint military drills and Australian support for defense infrastructure development in the Philippines.
So the Philippines is clearly aligning itself as part of that potential defensive crescent. What about powers further away like Europe or Australia?
European powers and Australia could certainly provide important support, things like munitions, drones, logistical help, and significant economic and humanitarian aid to Taiwan. However, direct military engagement from them is considered less likely, given the significant geographical distance and, for Europe especially, the ongoing resource drain from the war in Ukraine. Their focus might be more on sanctions and diplomatic pressure against China.
And India, a major regional power, also wary of China.
India, despite its long-standing official policy of non-alignment, would almost certainly view a Chinese invasion of Taiwan as a major threat to its own national security and economic interests. While direct military involvement is improbable, India is likely to exert significant diplomatic pressure and potentially use its growing economic influence to punish China through sanctions and trade restrictions.
And India has its own deterrent capabilities too, right?
Yes. India recently successfully test-fired its Agni-5 intercontinental ballistic missile. This missile is capable of carrying a nuclear warhead and could strike Beijing once operational. It's aimed squarely at strengthening defenses against China amidst their own ongoing border tensions. It's a clear signal of India's strategic capabilities and a potential complicating factor for Beijing.
But it's not just a potential alliance against China. We also need to consider the other side, the growing cooperation among China, Russia, and North Korea, often dubbed the axis of autocracy.
Absolutely. That cooperation is a critical factor. North Korea could certainly throw a wrench in the works during a Taiwan crisis. They could launch localized provocations, missile tests, border skirmishes with South Korea designed specifically to divert U.S. attention and resources, potentially forcing the U.S. to fight, or at least manage crises, on two fronts simultaneously.
A deliberate distraction tactic.
Exactly. It would significantly complicate any U.S. response planning for Taiwan. Meanwhile, Russia is seen as likely to provide military, economic, and political support to Beijing in a Taiwan scenario.
A quid pro quo for China's support over Ukraine.
That seems to be the understanding. Provided, of course, that supporting China doesn't negatively impact their own ongoing campaign in Ukraine. This highlights the increasingly interconnected nature of these global conflicts and the potential for a broad, coordinated challenge to the U.S. and its allies.
Okay, so we've looked at the defenses, the potential responses. Let's get into China's invasion blueprint. How might they actually try to do it? Strategy, tactics, the psychological aspects.
This is, of course, speculative, based on PLA exercises, doctrine, and analysis, but it occupies the minds of military planners globally. Timing and deception would be absolutely critical for Beijing.
Also,
Well, Beijing could try to time an invasion to be as disadvantageous as possible for its adversaries. For example, launching an attack when U.S. foreign policy attention and military resources are already stretched thin by major wars elsewhere, like in Ukraine and potentially the Middle East.
exploit distractions.
Right. China might also try to disguise the initial stages of the invasion buildup as just another large-scale training operation, which they conduct frequently. However, the sheer colossal scale of forces required for a full-scale war with Taiwan would make concealing the real thing extremely difficult. As U.S. Navy Admiral Papero recently warned, China's aggressive maneuvers around Taiwan right now are not exercises, as they call them, they are rehearsal.
Rehearsals for the real thing.
Yeah.
So, assuming they launch, what would the initial phase likely look like?
The initial phase would likely involve a blockade and barrage. Chinese naval and air force exercises over the past few years strongly suggest a comprehensive blockade of the island would be implemented almost immediately, possibly as a prelude to any attempted invasion.
Cutting Taiwan off from outside help.
Precisely. This would make resupplying Taiwan, as we discussed, far more difficult compared to Ukraine, which has open land borders with NATO countries. Concurrent with or shortly after the blockade, an initial massive missile and air barrage would target key infrastructure.
What kind of targets?
Military bases, airfields, naval ports, critical energy facilities. Our sources mention a Taiwanese LNG receiving terminal being specifically targeted in a recent PLA simulation called Straight Thunder 2025A, and vital undersea communication cables connecting Taiwan to the world. The aim would be to cripple Taiwan's defense capacity and undermine public morale right from the outset.
A swift knockout blow attempt. What if that fails? What about landings?
Given the difficulties of a direct assault on Taiwan's main island and its well-defended west coast, a stepping stone strategy is considered a likely approach. This would involve 3 distinct phases.
Okay, what are the steps?
Phase 1,
Yeah.
capture the small islands closest to the mainland, like the Kinmen-Quemoy Islands, which are just 2.9 kilometers off the coast of Xiamen. Phase 2, seize the Penghu Islands, the Pescadores, an archipelago strategically located in the middle of the Taiwan Strait, about 48 kilometers from Taiwan's coast. These could serve as forward operating bases.
And phase 3.
Phase 3 would be the main event. A full-scale amphibious and airborne assault on Taiwan's main west coast, likely targeting areas near major ports and cities. However, China has historical reasons to be cautious. Their failed October 1949 attempt to take Kinmen, which cost them 9,000 troops in just 3 days, still serves as a cautionary tale against overconfidence, especially in amphibious operations.
So seizing offshore islands first makes sense. For the main invasion, what are the key targets likely to be?
The ultimate success of a conventional invasion likely would hinge on whether Chinese amphibious landing forces are able to seize, hold, and exploit the island's large port facilities. As we noted, Taiwan's beaches are largely ill-suited for large-scale military landings due to terrain and defenses. Therefore, securing major ports like Keeling, Taichung, or Kaohsiung would be absolutely vital for bringing in heavy equipment and sustaining the invasion force.
Making the ports the primary objectives.
Likely yes, along with other logical targets like air bases, command and control centers, and major urban areas like the capital, Taipei, to try and decapitate the island's defenses and political leadership rapidly.
But you mentioned the beaches are difficult. Has China worked on ways around that?
They have. There's been significant innovation on the beaches, or rather, ways to create viable landing zones. Recent satellite images and analysis of tests conducted in mid-March 2025 show Chinese experiments with specialized ships, Shukwa ships, and modular causeway systems, similar conceptually to Xiancheng beach tests. These could potentially combine to create temporary hulking loading docks, almost like the artificial mulberry harbors used during the D-Day landings in World War II.
So portable piers to unload troops and vehicles, even on unsuitable beaches.
Exactly. If successful, this could greatly facilitate the rapid deployment of troops and heavy equipment onto stretches of coastline previously considered unsuitable for large-scale landings, significantly increasing China's amphibious assault options and operational flexibility.
What about airborne forces? Paratroopers.
China has also been massively upgrading its airborne forces. Reports suggest the PLA Airborne Corps could have about 450 transport aircraft poised to deliver these troops during a Taiwan invasion. This airborne component would be crucial for seizing key objectives behind enemy lines, airfields, bridges, command centers, and disrupting Taiwanese defenses from within, aiming to create chaos and link up with amphibious forces. It would be a multi-pronged assault designed to overwhelm Taiwan's layered defenses.
If the invasion progresses inland, especially towards Taipei, what then?
Then you face the grim prospect of urban warfare. Taking Taipei, which sits geographically in a bowl and ringed by mountains, making it relatively defensible, would almost certainly involve fierce resistance and grinding street-to-street urban combat. The result would inevitably be catastrophic military and civilian casualties on both sides. This would likely be the most brutal and costly phase for any invading force, drawing parallels to some of the most destructive urban battles in modern history.
Now, throughout this, China would also have to worry about the U.S. potentially intervening. How might they try to counter U.S. intervention?
Beijing has invested enormous resources specifically for this purpose, developing what's often called anti-accessoria denial, A2AD capabilities. This includes building a large inventory of precision weapons, most notably anti-ship ballistic missiles like the DF-21D and DF-26, sometimes called carrier killers, and advanced air-launched long-range missiles. These are designed explicitly to threaten key U.S. targets, particularly aircraft carriers and major military bases in Japan, Guam, and elsewhere in the region, pushing them further away from Taiwan.
So keep the U.S. Navy and Air Force at bay. What about non-kinetic attacks?
Yes, non-kinetic strikes would almost certainly play a major role. This includes sophisticated cyber attacks targeting military networks, critical infrastructure, and financial systems, as well as electronic warfare aimed at jamming communications and potentially debilitating U.S. satellites, crucial for intelligence, navigation, and communication. The goal would be to create a fog of war, blind the U.S., and significantly hinder its ability to coordinate an effective response.
Finally, there's the psychological dimension of all this, both for China itself and for Taiwan.
Absolutely crucial. Domestically, the Chinese Communist Party faces significant challenges: an aging population, a shrinking workforce, high youth unemployment, and that struggling property market we discussed earlier. Public appetite for a potentially prolonged, costly, and bloody conflict is uncertain. Therefore, intense propaganda efforts will be essential to justify the invasion to its own population, frame it as historically necessary and righteous, and blame Taiwanese separatism or U.S. provocations.
Towards Taiwan.
Towards Taiwanese society, the psychological warfare, or cognitive warfare as it's often called, would be relentless. Disinformation campaigns would aim to induce doubt about their government and military, degrade confidence in their ability to resist, sow internal divisions, and crucially, convince the Taiwanese public that the outside world is not coming to its aid, thereby eroding their will to fight.
Trying to break their spirit before or during the conflict. So what are the potential triggers that might actually push Xi Jinping to launch such a risky invasion?
It's complex, but analysts point to a few potential scenarios. An invasion could be triggered if Xi Jinping's personal political standing weakens significantly within the party, perhaps needing a nationalist rallying cry. Or, paradoxically, if China's internal economic and social challenges deepen dramatically, an external conflict could serve as a distraction. Another key trigger could be if Beijing concludes that its window of military advantage over Taiwan, and potentially relative to the U.S., is at its peak, and that waiting any longer would risk a shift in the strategic balance against them, perhaps due to Taiwan's accelerating defense improvements or stronger U.S. alliances.
So a complex mix of internal pressures, perceived opportunity, or perceived closing windows. These are clearly the critical pressure points we need to watch in the coming months and years.
Without a doubt, they shape the entire geopolitical chessboard.
Okay, that was an incredibly detailed look at the Taiwan situation. Let's shift gears now closer to home for some pressing U.S. domestic news updates. A mix of cybersecurity, tech, and other significant headlines. First, a major development in the ongoing cybersecurity standoff with China.
Yes, this involves Microsoft. Microsoft has reportedly moved to sharply curtail Chinese companies' access to its so-called Cybersecurity Vulnerability Disclosure Program, known as MAPP.
Curtailing access. Why?
It follows growing suspicions and apparently some evidence that early notifications about software flaws provided through this program were being leaked to state-backed hackers in Beijing before patches were widely available.
So instead of fixing the flaws, the information was weaponized.
That's the strong suspicion. The stakes here are incredibly high. Microsoft recently attributed major global cyber attacks, known as Toolshell, which exploited a vulnerability in its SharePoint software, to 3 distinct China-linked hacking groups. These attacks compromised more than 400 organizations worldwide, including sensitive targets like the U.S. National Nuclear Security Administration.
Wow, and this links back to Chinese regulations.
It does. It highlights the severe risks embedded in China's regulations that actually mandate that companies operating in China disclose newly discovered software vulnerabilities to state agencies within 48 hours. The concern is that agencies like the Ministry of State Security, MSS, might be stockpiling these flaws for future offensive cyber operations rather than ensuring they get fixed quickly. Microsoft's move reflects a deep distrust stemming from this potential misuse of vulnerability information.
A significant escalation in the cyber realm. Okay, moving to tech and space developments. All eyes seem to be on NVIDIA's pivotal earnings report this Wednesday.
Absolutely. NVIDIA has become the undisputed poster child of the AI boom, right? Its stock has nearly doubled just since April. This earnings report is being considered nearly as consequential for markets as Powell's words themselves.
That's saying something. Why so much weight on one company's report?
Because NVIDIA's chips are the backbone of the AI revolution, its results are seen as a barometer for the entire AI sector's health and growth trajectory. The options markets are bracing for a potential swing of over 6% in NVIDIA shares post-earnings, which, given NVIDIA's massive market cap, could significantly impact the direction of the broader S&P 500 index.
And the CEO is in Taiwan.
Interestingly, yes. CEO Jensen Huang is currently in Taiwan, reportedly assessing demand for its H20 chips, the less powerful versions designed to comply with U.S. export controls to China. He noted that any decision on potentially allowing newer, more powerful AI chips for China ultimately rests with the U.S. government. It's a high-stakes moment for the company, the tech world, and the broader market.
Okay. And also in tech, but looking upwards, the space race continues.
It does. A SpaceX Falcon Heavy rocket successfully carried the X-70 military spaceplane into orbit recently. This reusable, uncrewed vehicle is built by Boeing and operated by the United States Space Force. This marks its 8th classified mission.
8th mission.
Right.
Still mostly secret.
Yeah.
Right.
Mostly, yes. Most mission details remain under wraps, but the program has declassified some past experiments, like studying how space radiation affects seeds, which could aid planning for future long-duration human missions to the Moon or Mars. It represents a quiet but consistent advancement in U.S. space capabilities and strategic military research in orbit.
Okay, now for a couple of other significant headlines making waves. What's the latest on TikTok?
Well, President Trump is reportedly still addressing the security concerns related to the Chinese-owned app. Sources say he's actively exploring potential American buyers for the platform's U.S. operations. But for now, the deadline for a potential ban or forced sale will apparently be extended a little bit longer.
Kicking the can down the road a bit while exploring options. What about TikTok itself?
Meanwhile, TikTok itself is undergoing a broader restructuring of TikTok's European operations. They're reportedly laying off hundreds of employees in London and Germany and planning to rely more heavily on AI for content moderation and security tasks. This likely reflects both global regulatory pressures and perhaps internal cost-cutting measures.
Interesting. And a conviction in a U.S. espionage case.
Yes, a U.S. Navy sailor was convicted of espionage. Jing Chie, a sailor stationed aboard the U.S. Essex, was found guilty of selling sensitive military secrets, including photographs of the ship, details of ship movements, and weapons systems information to a Chinese intelligence officer.
How much did he sell it for?
Reportedly, more than $12,000 over an 18-month period. It's another stark reminder of ongoing espionage efforts targeting U.S. military personnel and information.
And back to India quickly. We mentioned their Agni 5 missile test earlier.
Right, just to reiterate, India's missile power demonstration involved the successful test firing of its Agni 5 missile from its eastern state. Again, this missile is capable of carrying a nuclear warhead and could strike Beijing once operational, clearly aimed at strengthening defenses against China amidst those ongoing border tensions.
And finally, that Philippines-Australia pact we touched on.
Yes, the Philippines-Australia Defense Pact was formally announced on Friday. This new agreement is explicitly designed to step up military cooperation to address regional security challenges posed by Communist China. The pact will pave the way for more frequent and complex joint military drills between the two countries and Australian support for defense infrastructure development in the Philippines. It's another clear piece solidifying that potential crescent of defense aimed at deterring Chinese expansionism in the South China Sea and beyond.
Wow, Pi, what an incredible journey we've taken today. That really covered the globe, from the nuanced dance of Federal Reserve policy and those splitting realities of the American housing market.
The mortgage divide and the lock-in effect.
Exactly, all the way to the deepening crises in major global economies like China, Saudi Arabia, and Germany.
And then diving deep into the complex geopolitical currents, Europe's diminished standing, that incredibly intricate and tragic proxy conflict playing out in Myanmar.
Yeah, the foreign powers hedging their bets there.
And of course, that incredibly detailed, high-stakes scenario brewing around China and Taiwan. Potential triggers, defenses, invasion plans. It really is a dense web of interconnected economic and geopolitical shifts all playing out in real time.
Absolutely. And, our mission here at the Deep Dive is really just to try and provide you, our listeners, with some clarity in this rapidly changing and often confusing world.
Yeah, to give you those essential insights, maybe some surprising facts you need to feel not just informed, but truly well-informed, hopefully helping you navigate these complex global dynamics a little better.
Precisely.
So as we wrap up this deep dive for today, we want to invite you to ponder this provocative thought. Given the confluence of all these things we've discussed, the economic anxieties, the recalibration of global alliances, these looming geopolitical flashpoints from Eastern Europe to the Taiwan Strait, what unexpected global event, maybe something seemingly small or off the radar right now, might serve as the next major catalyst for change in the coming months?
Ooh, that's a good one. A subtle shift, a dramatic turn, or maybe something entirely unforeseen. Definitely something to keep your processors churning on.
Indeed.
Thank you all for joining us on this deep dive into the most pressing current events. If you found value in our work today, please remember to subscribe wherever you get your podcasts.
And if you're able to, please do consider donating on our GoFundMe page. It really helps support these daily explorations into the complex world around us.
It absolutely does. Until next time, stay curious, stay informed,